Okay, we're back with Neil Kimberley, external forex analyst for ActivTrades, making his debut, international debut, as Moose would say, on TIP TV. Good morning, Neil.
Good morning. Pleasure to be here.
Right, and I still have, well, you've switched around here. Bill Hubbard, Chief Economist for Bullion Capital, as well as my co-host. Neil, possibly one of the busiest 48 hours ever in the history of the financial markets. Is that not too much of an exaggeration, is it?
You mentioned it earlier on. There's a tremendous amount. We've got Mario coming out later. Whatever else he does, he's going to probably boost up the equity markets again through what he says. It's negative rates is probably good for equities. And consequently, stocks are going to move up. So if you're an ActivTrades customer, you've got those free CFDs, no fee, no data fees, no commissions till January the 15th. Good time to get in and play the Sansa rally if that's what you want. And as you always say, trade responsibly. But moving on, we've got Janet Yellen.
I'm not sure if I do actually say that.
On TIP TV does.
Enjoy yourself. Enjoy yourself.
TIP TV does. Janet Yellen.
Yeah.
We don't want to rehash everything you've already said, but it's a lot going on, and a lot of it's interconnected as well, I think.
I think the only question is, from the trading perspective, how much of whatever's going to happen today has been factored in? I mean, the DAX is up from, 9,500 to 11,000, whatever it is. It's up 20% over the last few weeks. Lots of markets have apparently factored in. We've got the weaker euro, we've got the stronger equities and weaker gold for some reason. I'm not quite sure why that is. But you've got markets which have positioned themselves for whatever's going to happen now, anticipating that. Is it going to be a snapback or is it going to be more of the same?
In continuation of that, how much do you see? I would say probably 70% of the people in both the city and on Wall Street have never seen a rate hike.
No, that's right.
So, it's for us it's different. But where do you think with what Zach was saying, where is their mental concentration or strength in this situation?
Well, I think two things I'll bring out straight away is I don't care what Draghi does. Euro's going down. They need it. They're desperate for it, and everything we've seen this week is pointing that way. As regards the equity market rallies, if I'm longer the DAX, I'm hedged on the currency anyway. I've got to be. Yeah. Because the two things are doing the same thing. Can it go much further? It's an artificial market. Central banks have crowded out price discovery. You just go with the flow. It's the guy, like the guy from Citibank. The music's still playing. I'm still dancing, and hopefully you're off the dance floor before it goes pish. But as regards, like you said, you can see the market. You've got Goldman Sachs yesterday talking about the Chinese cutting to zero and at the same time talking successive Fed rate hikes. Janet Yellen, she wants a shallow trajectory. You know what? None of these guys are in charge of the situation. There's a dearth of dollars out there globally, and that's why the dollar's up.
Well, let's go back to what Greenspan said 30-odd years ago, okay? Basically, at a conference for the U.S. Bond Market Association, he was asked a question about Fed preparation. He says, oh, no, you market makers make the levels. We just react accordingly.
Which is not a great thing, is it? It's not very helpful. They've been telling us
But I trusted Mr. Greenspan. I'm not sure.
I think the G-Man was the beginning of the problems we've got, in the sense that there was this kind of reaction along the way, and now we've got to a situation where 7 years into an economic recovery in the States, we've still got emergency rate settings. Is that apt? I don't think so. And on this side of the pond, the Eurozone is a shambles, an absolute shambles. They can't get the ECB is the only person holding this up, because every time they do more in the way of easing, the governments within the Eurozone who should be restructuring go, Draghi's doing the work for us. We don't have to do anything. Now, if you're a central bank in Asia and you've been broked over the last 15 years into seeing the euro as a major reserve currency, you've got to be holding this baby. You know what? They're charging you now for holding it.
Are you then the same person that's buying Bitcoin? With that kind of
I think if you look around the world, what you've seen since 2008, and this brings us onto Asia in particular, because they're the first ones to smell a rat, is you've seen very low US interest rates for too long, a massive increase of dollar-denominated debt around the world. It's leveraged. The Fed's not printing so much. The situation in America has changed as regards commodities because you've got the shale gas and shale oil. That affects the Triffin dilemma. You've got regulators around the world telling people you've got to hold more capital, so cash is king. And everybody owes dollars. So everybody's trying to get dollars in to repay the debt, or at least keep it rolling over. Let's pretend everything's all right. We've got $1 trillion of non-performing exposures in the Eurozone, according to the European Banking Authority. And I guarantee you that's an understatement.
I was going to say.
You go further east, you've got the Japanese, 240% public debt to GDP ratio. The Japanese banks have lent bucket loads of dollars in the last 2 or 3 years. They've massively increased their dollar loans. And all of a sudden, they've got lots and lots of yen from QQE, lots and lots of yen from Japanese policies over the last 15 years. But you know what? They've got apples and they need pears. So they're having to swap into dollars. And the market knows it. And the Japanese banks know it. So the Japanese banks are paying up for dollars over the turn of the year. And therefore the dollar remains big. And it's dollar demand across, it's a secular, dollar's going up.
It's going to destroy, but is that just going to destroy the emerging markets, isn't it?
Emerging markets have had a lovely ride. You know, they complain bitterly about the Fed cutting rates to zero and the currency wars and money coming in and driving their currencies up. Now they're complaining bitterly because capital's going out. Can't have it both ways, boys.
I mean look at Brazil as a classic example. Look at their comments over the last 10 years. As you just said, we're bullish, bullish, bullish. Now we're bearish, bearish, bearish.
They're built up. And China, to an extent, is the same. Because since 2008, they did everybody a favour. They kept the world economy going by pumping, 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 and now you have a tremendous amount of malinvestment based on dollar debt. And all of a sudden it's, well, that's steel factory, that's steel furnace, not worth anything anymore. But you know what? You've still got to pay the interest on the loan and repay the debt. So you've got to get the dollars. And all of a sudden you've seen since the summer, capital trying to get out of China. SLJ Macro estimated $600 to $800 billion left China through capital flows since the beginning of summer. Is that 3 or 4 months? Bank of Tokyo Mitsubishi estimates that to get to 10% yuan reserves, following the SDR decision, somebody's going to have to buy about $1.25, $1.3 trillion over the next 5 years. Well, 800 billion may have come out in 3 months, and you're telling me about 1.3 trillion over 5 years? No wonder this thing isn't going to go anywhere. The yuan has to weaken. The yuan has to weaken. As they go from an export-led economy to a consumption-led economy, you have to raise wages to create the personal disposable income for the Chinese guy to spend on the stuff that you're making in China.
But then you go back to the simple fact is, we know it. And the Federal Reserve would have to know it, the Bank of England would have to know it. Hence the reason, the people that were saying that the Federal Reserve, and they're well behind the curve now, when they didn't move, I thought they'd move in June, I was sure they'd move in September, then that argument by saying they were concerned about China, they already knew these flows, okay?
They did know these flows, but the trouble is, the Americans, as far as I'm concerned, and Jacob Lew did a good interview yesterday, we said, well, the US dollar is the world's prime reserve currency for a very good reason. For a very good reason. They're determined to keep that situation. If you look at what the IMF did with the SDR on Monday, oh yes, the yuan's coming in, 10.92%. Who got hit? It wasn't the dollar.
No.
The dollar dropped a little bit.
Yes.
The euro was absolutely hammered. The world's second largest reserve currency.
And I think another thing that people don't seem to understand is that 38% of U.S. debt is owned by the Chinese and the Japanese. So are they going to trash the dollar to trash their own, one of their few earning assets? Of course.
You saw what happened during the summer. We had the capital flows coming out. PBOC leans against it. He's selling dollar yuan. He's selling dollar yuan, and all of a sudden, you know what? He gets on the 11th of August, goes, can't be doing with this. Reserves are going down to it. And also, don't forget the way that the balance sheet is figured. In China, you get the liability side. A lot of it's made up by the reserve requirements from the banks. The asset side is largely made up of US treasuries.
Yeah.
So when you cut your reserve ratio, you give money back to the Chinese. You've got to get the money back from the assets.
At the first plenum, which was 10 years ago or something, Hu Plung Pu or whatever his name was, he said, remember, we're one country, one economy, two currencies, okay?
Chimerica.
Yes. You know, and the Hong Kong dollar, last time I looked, was still pegged 1-to-1 to the US dollar. Yeah. And you know as well as I do, had it not been for Hong Kong, Taiwan wouldn't be one of the strongest nations in Asia.
It's all interlocked. Everything's interlocked.
It's interlocked, but then the problem with this is it looks like we've got a burgeoning horror story. I mean, there's no way that any of this is going to end.
I never promised you a happy ever.
I was looking forward to that, but no. But you got that sort of, you know, these flows, these massive flows, which are presumably the result of having the QE and this emergency policy. The unintended consequences are actually much worse than the original emergency was.
Exactly. Well, if we haven't dealt with it, have we? We just we kicked the can. The financial crisis.
We created a bigger one, which is the deal was we would delay the implosion of 2007 and 8 until we could cope with it, or we could sort of rejig things.
You know what?
But actually, we've created a much bigger one.
They didn't learn the mistake. They didn't learn from Japan. You go back to the QE, when QE started in the 1990s. I was at a Japanese
but
bank.
they deliberately copied Japan.
Yes, but they didn't understand where Japan's banks kept rolling over the bad loans from mid-1990s to about 2004.
A margin call sort of
Just
thing.
keep paying, because it's not costing you anything. Evergreening the loans, they call it. What was the point? The new lending, bank lending in Japan went down for 55 successive months. And all of a sudden, Prime Minister Koizumi comes in, Koizumi-san says, you know what? We got to fix this, guys, because we ain't going nowhere. And all of a sudden, I remember, we classified everything as a bad loan. If we didn't like the colour of your shirt, we would classify you as a bad loan. And that's how they got out of it. And that's how we went. You remember 17 city banks in Tokyo back in the late 80s, early 1990s. We got 3 mega city banks now.
That's right.
That's what you call a banking rationalisation. How many hundreds of banks have we got in the Eurozone?
But
We haven't done it.
Who was the genius who came up with this idea of the bailing everybody out in the QE in 2007 and 8?
Policymakers can only use the levers they can
Who was it?
have.
Was it Greenspan, Bernanke? Was it George W. Bush?
But what was the alternative?
Let it go bust.
And then, I mean, look at the UK. The talk was in the UK, we were about a couple of
wouldn't have
hours
Royal
away from
Bank of
closing the
Scotland.
ATMs down.
Yeah.
But you had no choice. You're a policymaker, you're an elected official. The exercise of power. You want to retain the exercise of power. You will do, if somebody says to you, well, you know, if we do this, we don't have to take the pain.
But nobody's put their name to that. No, there was no meeting or no summit where it was decided that. It just happened.
It just evolves. It just evolves. But you have to deal with where we are now.
But presumably there's a reason for that, because nobody wants to take the blame for that.
No one's going to take the hit if it means you're going to close down the ATMs in the UK or in the United States because a major bank's gone bust. You can't do that.
Gordon Brown, though.
So you keep playing the game.
No, he just sold gold.
Yeah, his timing wasn't great.
No.
But I mean,
Yeah, but you see, one of the things I think,
the way he did it was
Yeah.
I'm going to sell it today at a certain time.
No.
Yours.
He announced the whole program, and I will guarantee, I'll go to my grave, that 90% of what we sold is in Beijing.
Well, I think Beijing is ultimately moving towards a more gold-backed yuan.
Exactly right.
And they're going to do it very slowly, incrementally. I mean, I think you were talking about gold earlier on. I think there's 2 reasons why the gold's coming off. One is this secular demand for dollars. And I think this is the key point. There's a secular demand for dollars, which the trading fraternity doesn't get yet. But when you talk to central banks, as I do, it's quite clear there is a dearth of dollars around the system at the moment. The other thing is with gold is everybody thought China was building up gold at a rate of knots. But the latest data is that, at least what they're telling us, is that they're not building it up quite so quickly. So some of the support for gold has come away.
Yeah, because I think one of the things they've always tried to do is buy it on a downtick, okay? They're looking at 1044, they're probably looking at 1,000, and maybe even going into the mid-900s, okay?
And also, what's the time frame? We deal in America with a 4-year time frame presidential. In the UK, 5-year. President Xi's got 10 years.
Right.
I was told an interesting story from a G7 a couple of years ago where China was being lambasted by the Americans about their failure to strengthen the yuan at that time. And the Chinese said, well, you know, we're going to get there. We're building a country for the 21st century and beyond. This is a culture of 1,000 years. We don't think things overnight.
You just said it, you see. That's the Oriental thinking, okay? There's always tomorrow, 1,000 miles begins with one step.
If you write the date in Japanese, you don't put the day or the month first, you put the year.
Yeah.
That's the key thing. And I think we look at it from a different perspective. But going back to this anecdote, Chinese guy stood up and said, you know what? We're not complaining. Jimmy Carter signed legislation in 1980 saying that you weren't going to sell arms to Taiwan. It's 2006 now. You're still selling it. We're not moaning, because you will get there eventually. But don't judge us by your 4-year presidential timeframes.
Neil Kimberley, stunning debut, external forex analyst for ActivTrades. Thanks for coming in today, and hopefully you'll be back again soon.
Pleasure. Thank you for having me.
Thank
Thank you. We'll be back after the break.